Watch Your Assets, where we've got your money on our mind. I'm your host, Stephanie Bracken, and today we're talking about a very exciting topic, taxes. So I'm filming this on April 1st. So if you haven't done your taxes for 2024, you have until the 15th to get them done. Our cameraman is pointing to himself. There's still time, and you can always file an extension if you haven't done them. You have until October to get them done if you do file an extension. But what we're going to be talking about today is tax strategies. My hope is that there are some things you can take away from today's episode that are strategies that allow you to potentially keep some more money in your pockets. So maybe these won't apply for 2024 if you've already done your taxes for this year, but maybe they can apply for 2025 and beyond. So let's get into it. Now, I want to put a disclaimer out there that I am not a tax professional. If you want to learn more about these strategies and if any of them that I'm going to talk about apply to your unique situation, please consult your tax professional and ask them for their expertise. Have you ever wondered why people always say the rich get richer? Why is that? People get upset sometimes when they think that the rich don't pay their share. That's a very common thing that we hear in today's economy. And while I understand the sentiment of that, the rich have found ways, legal usually legal loopholes around how to avoid paying taxes. The 1% also makes money differently than the other 99% typically. They own businesses. They have passive income through things like real estate or investments. They're typically not W 2 employees. There's a wonderful book by Robert Kiyosaki called Rich Dad, Poor Dad that explains this in great detail. And he talks about the 4 legal ways to make money in our country. Those are working a job, that would be your W 2 income. You can be self-employed. You can work for yourself, be a small business owner. You can own a large corporation where you have, 500 plus employees. And you can also earn money passively, again, through investments, through real estate, through other businesses that generate money without you having to do too much in the business itself. So that's the passive versus active income. But in general, you don't have to be rich to think like the rich and to take advantages of some of the strategies that they use to keep more money in their pockets each year. So let's start with some basics, okay? We have a couple different tax filing statuses that can be used in this country when you file your taxes. You can be a single filer. This is, of course, if you are unmarried, if you're legally separated or divorced, and who you don't qualify for any other of these tax filing statuses that I'm going to talk about. This is the most unfavorable status in terms of your tax brackets, and I'm going to get into that a little bit later. But it doesn't pay to be single in this country typically, unfortunately. You can file head of household. These are for unmarried individuals who maintain a household where there are qualifying dependent children or other relatives that live with you as defined by the tax codes. Other relatives can be people like parents, your in laws, nieces, nephews, aunts, uncles, or who is unrelated but who lives in your home and you provide at least half of their financial support. That relative's income has to be less than $4,700 per year for you to be able to claim them as a dependent on your tax return as well. Then there's married filing jointly. This applies to spouses who, of course, are legally married. If your spouse passes away during the year, the remaining spouse, the surviving spouse, can file married filing jointly for that particular year. And then after that, they'll either have to file for single filer status if they don't have any dependent children, or you can file for the qualifying widower or widow. In that status, the qualifying widow or widower, you're a taxpayer with a dependent child who your spouse passed away within the past 3 years. So in the year that your spouse passes away, you can continue to file married filing jointly. After that, if you have a dependent that you care for, you can take advantage of this qualifying widower status. After 3 years, you jump back down to the single filer rates. Then you can also be married but file your taxes separately. This is where you're legally married, but you've both decided that you want to file taxes separately for whatever reason. It doesn't have to be that there's any kind of animosity. This just might be something that you keep your finances completely separate, and it just makes more sense for your situation to file separately. The caveat with this is that both spouses have to agree to use the married filing single status, and each spouse, of course, files their own returns and apply their own deductions and credits for their own returns. And then we've got our tax bracket. So we have the way that you file taxes is based on your marital status, more or less. Or if you have dependent children, of course, you can take advantage of the head of household status, and then qualifying widower. And then let's talk about how that status affects your brackets. So there's going to be differences between the single filer rates and the married filing jointly rates. The single filer brackets are a little more condensed than your married filing jointly brackets because, assumingly, there'd be two incomes in a married filing jointly household. So they expand the brackets to account for that. So the single filer rates are a little more squished. And what this means, and why I was saying the single status is a more unfavorable tax bracket to be in potentially, or a filing status to be in, is because this could potentially lead to higher tax bills depending on how much money you make each year. For 2025, the top federal income tax bracket, the marginal tax bracket, is 37% for individual single filers who have income greater than $626,350, or if you're married filing jointly, that's $751,600 to be in that 37% tax bracket. An example of some of the other income thresholds that keep you within a certain tax bracket. If you make, let's say, for example, if you're married filing jointly and you make anywhere between $96,950 and $206,700 for 2025, that's going to put you in the 22% federal tax bracket. Now, keep in mind that our tax brackets are marginal and they're progressive. So this means that even if you jump into the next tax bracket, only the dollars that are above a specific breakpoint are going to be taxed at that particular rate. So let's take, for example, a married filing jointly couple who together made $220,000 for 2025. This will put them in the 24% marginal tax bracket. In this case, not every single dollar is taxed at the 24% tax bracket rate. The first $23,850 is taxed at the 10% rate. The next $73,100 is taxed at the 12% rate. The next $109,750 is taxed at the 22% rate. And then the final $13,300 is what's taxed at the 24% bracket. So you can see here that the tax system is progressive. So you're not going to be taxed on every single dollar at that rate. I think people get a little bit afraid to make more money because they're afraid they're going to jump into a higher tax bracket. And that might be the case, but it's not that every single dollar is going to be taxed at 24%. It's just, in this case, that $13,300 that's going to be taxed at the 24% rate. Then the next thing to think about whenever you're preparing your taxes is taking advantage of deductions and credits. So these are two different things that are going to play into your tax situation. Deductions lower your taxable income versus a credit, which lowers your tax bill dollar for dollar. So for deductions, I think people are most familiar with the standard deduction. For 2025, your standard deduction is $15,000 if you're single, $30,000 if you're married filing jointly, $22,500 if you are head of household. So you can see the head of household limits sort of fall between your single filer and your married filing jointly brackets. And that kind of remains the same for the actual brackets, but this is for the standard deduction specifically. So the way you apply your standard deduction is you're going to arrive at your adjusted gross income, which most of the time is going to be just your taxable income. There's a few things that will be subtracted away from that to arrive at your adjusted gross income, hence it being adjusted. But for the most part, it's going to just be your taxable income. Then you're going to subtract the greater of itemized deductions or the standard deduction. Itemized deductions can be higher if you've done things like paid mortgage interest. I think that's one most people are familiar with. Sometimes the amount that you pay in mortgage interest is going to be higher than your standard deduction, especially if you're married filing jointly. Also, your student loans are that interest payment is deductible as well. Maybe if you had a large medical bill throughout the year, you can deduct that as an itemized deduction. Now, there's a caveat with that where your medical bill had to be greater than 7.5% of your adjusted gross income to be deductible. And charitable donations are another popular one where if you donate things to Goodwill, if you give to your church, if you just donate any dollars to your favorite charity, those are things that can add up to maybe make your itemized deductions greater than the standard deduction. Then take your adjusted gross income minus either, again, the greater of the standard deduction or your itemized deductions, and that is going to bring you to your total taxable income. Then, once you have that number calculated, then you're going to apply your credits. And what's going to happen here is you're going to be able to, your CPA is going to be able to help you claim the credits that you're eligible for. And I'm going to list a few of the popular ones, but this is not an exhaustive list, and not every single credit is going to apply to every single situation. But your CPA will understand your situation and they'll know which credits will apply to you. There is the child and dependent care credit. Most people will receive about 1200 in a tax credit for 2+ children because childcare is very expensive. You can deduct a lot of your childcare expenses, but it's probably going to equate to a tax credit of about $1,200 if you have 2 or more children, 600 if you have one child. There's also the child tax credit, which is different than the child independent care credit. The child tax credit is a $2,000 tax credit that's given for each qualifying child that is under 17. So if you have 5 children, multiply 2,000 times 5, that's your tax credit for the year. There's also for healthcare premiums if you have retired but haven't reached Medicare age yet. There's something called the marketplace tax credit. This is a tax credit that can potentially be used to lower your monthly health insurance premiums before you reach age 65 and would be on Medicare. Then there's the American Opportunity Tax Credit and the Lifetime Learning Credits. So both of these, of course, are for educational purposes. So the AOTC, the American Opportunity Tax Credit, gives a credit of up to $2,500 per year for qualifying education expenses during the first 4 years of post-secondary education per eligible student. If you have triplets who are freshmen in college, you can claim a $7,500 dollar AOTC credit. This is only for the first 4 years of school for college education expenses. So you can't use this for K through 12, and you can't use this if you have a student who's in grad school or who has gone beyond 4 years of school, or if you've already claimed 4 years worth of the AOTC for that particular student, you can't claim it for that 5th year or beyond. There's income limits to this one. If you're single and make over 80,000, or if you're married filing jointly and you make over 160,000, you will not be able to, or you'll be able to claim this up to those limits. You can't claim the credit if you're modified adjusted gross income, which is slightly different than the adjusted gross income. If it's over 90,000, if you file single, or 180,000 if you're married filing jointly. So if your household makes above those thresholds, you can't claim the American Opportunity Tax Credit at all. Then there is the Lifetime Learning Credit. This is a credit of up to $2,000 per year for qualifying education expenses that can be claimed for an unlimited amount of time, an unlimited amount of years. So let's say, for example, You have a child who is in grad school, you've already claimed the AOTC for their 4 years of undergrad. You can still claim the lifetime learning credit for their time as a grad student. But let's say you also want to take some post secondary educational classes, certifications, get your master's degrees, things like that. You also can claim that credit for yourself. You can't the caveat for both of these together is that you can't claim both credits on the same student in the same year. So you do kind of have to pick and choose. And again, your CPA can help you navigate which one is right for you. And also, if you paid for college expenses with a 529 plan or other qualifying educational type investment account, a Coverdell education plan is going to be subject to this as well. Those expenses that you used to pay, or the expenses that you paid for with your 529 plan, you can't claim the credit against those dollars. So this would be anything if you exhausted your 529 plan funds and you still have more education expenses to take care of for your child. Anything above what you used for that 529 plan, you can use the credit for that, but not what you used for the 529 plan specifically. Now let's move on to kind of the meat and potatoes here. That's kind of your basics. That was your tax 101, right? And again, I'm not a tax professional, so that was just a very high level overview of our brackets, single file or status, the tax statuses that you can file in, and some of the credits and deductions that you can claim whenever you're filing a basic return. But let's really get into some tax saving strategies here that you may or may not want to take advantage of, but I'm going to at least present the information. And then again, we can certainly assess if these things apply to your situation, and your CPA can do the same. So, the first one I'm going to talk about is contributing to a 401k, a 403b, a traditional IRA, your non Roth retirement plans. When you contribute to the pre tax bucket of your 401k, this can offer immediate tax savings for you. These contributions, if you listen to my last episode on qualified retirement accounts, you will know that these contributions are taken out before you pay your taxes. So you're going to get your paycheck, the deductions are going to come out for your 401k, whatever percentage it is you want to contribute into that, and then your taxes are going to be applied after that. That means that those dollars were not taxed on the way in. What this means is you are going to get some tax savings immediately on those dollars because you didn't pay taxes on them. So you're lowering your taxable income by contributing into that pre tax bucket of your 401k, 403b, and the like. Contributing to the Roth bucket, on the other hand, or a Roth IRA, offers no immediate tax savings, but your growth and your withdrawals after age 59 and a half are going to be tax free and could potentially save you in more taxes paid over your lifetime, but it's going to depend on your situation. A lot of that is going to depend on what is your retirement income in total and what tax bracket does that put you in retirement. A lot of the times people are in a lower tax bracket than they were when they were working in retirement. So there still might be advantages to contributing to the pre-tax bucket versus Roth. So it just depends on your situation. Business owners, if you're listening and you're a business owner, you can contribute to your own 401k. They call them solo 401ks. Keogh plans are another term for this, or a SEP or a simple IRA as the employee and the employer to maximize your retirement plan contributions and your deductions. Because, of course, as the employee, you're going to get the tax deductions, as I just mentioned, but also as the employer, you're going to get some tax deductions for putting funds into those accounts for you and your employees, and get the deduction immediately in that particular tax year. Another strategy is contributing to an HSA. So, this is going to be your health savings account. This will only apply if you have a group employer plan that is called a high deductible health plan, an HDHP. So, not every single health insurance plan is going to offer an HSA. You have to have a high deductible plan to have this HSA. But when you do contribute to that HSA, your contributions are going to be tax deductible, just like your 401k, IRA contributions, things like that. It's also going to grow tax free, and it can be withdrawn tax free if you use that money for qualifying medical expenses. And you don't have to hit a certain age limit to be able to pay for qualifying medical expenses with your HSA dollars. You can use them that same year if you want to. Typically, with an HSA, you can also roll those funds over into subsequent years versus an FSA that's kind of a use it or lose it plan. So, an HSA can also serve as almost a secondary investment account, where you're able to select investment choices based on the sponsor company that is offering your HSA. You'll be able to choose some investments to let your money continue to grow with the markets over time if you don't use it every single year. Then there's a special thing that happens with HSAs once you reach age 65. After age 65 in an HSA, if you still have money in it, even if you're not working anymore, you can carry these with you past retirement. All of your withdrawals are going to be penalty free. It doesn't matter if you use them for qualifying medical expenses after that point. You're still going to pay taxes on those dollars if you don't use them for qualified medical expenses, but you're going to that 10% penalty is going to go away. So, they almost function like a pseudo IRA in retirement, because now you're going to just pay your normal taxes on it like you would on your IRA distributions. But that doesn't start till after 65. For IRAs, that'll start at age 59 and a half whenever that 10% penalty goes away. So, a little bit longer that you have to wait to use those funds, but you have the option to if you need them. One of our favorites to talk about is Roth conversions. This is another strategy that may save you taxes in the long run. This is the process of taking traditional IRA or 401k dollars and moving them or transferring them into a Roth IRA. What happens when you do that is that's treated as a distribution in the eyes of the IRS. So you're going to pay taxes on those dollars that are converted. You are not limited to how much can be converted every single year. You can convert as little or as much as you want to. Kind of just depends on your appetite for taxes in that year because that income is going to be fully taxable at your ordinary income tax rates, but it's something to possibly consider. This is the hope is to convert in years when your income tax bracket is possibly lower, aka in retirement, usually, than it will be in the future also. So, one of the things that can happen in an IRA is, again, if you listen to my qualified retirement podcast, you know what an RMD is. So at some point, you're going to be forced to take distributions from your qualified accounts, whether or not you need the money. You can take distributions before you are required to, but there's a point where you're going to be required to take distributions from those accounts. Those distributions are also fully taxable. And because you've let those accounts grow from the time that you started working basically to the time that you're 73 or 75 depending on when you're born, that those RMDs can become quite a lot. So if you're in the 12% bracket, for example, but you have millions of dollars in an IRA, your RMDs are probably going to be pretty significant and are probably going to push you into a higher tax bracket whenever those are required to start. So the goal with Roth conversions is to get ahead of that tax burden potentially and shift that liability towards the front end of your plan as opposed to the back end of your plan whenever you're 73 and beyond. And you're also potentially saving your beneficiaries in taxes as well, because Roth money is not going to be subject to any RMDs, but it's also going to be tax free to you once it's converted and your beneficiaries when it's inherited. What this means is that anytime your beneficiaries want to take distributions from that inherited IRA, Roth IRA, that income is not going to be taxable to them. So it's going to be tax-free money. Now, it has to be depleted within 10 years of inheriting the accounts, same as a traditional IRA, but that money's not going to be taxed. And so that can potentially save your beneficiaries a larger tax burden down the line as well. But again, Roth conversions are one of those things that we want to make sure we really take a measured approach on, and we want to make sure that that applies to your situation. Sometimes it doesn't make sense for everybody. I'm back to business owners now. Another strategy for you is to take advantage of depreciation deductions on any of your equipment that you have that are depreciating assets. Consider registering as an LLC or as an S corp to optimize your tax treatment. Deduct home office expenses, mileage, internet, phone bills if you have a home office. Now, you don't need to be a business owner actually to take advantage of those. You can still deduct your internet, part of your internet bill, anyways, part of your phone bill. If you've purchased laptops, other equipments that you need to work from home, you also can take advantage of those deductions. Another big one that we talk about with our clients is tax loss harvesting. Now, I have quite a bit of notes on this, so bear with me on this one. But tax loss harvesting is a strategy that we utilize to offset some capital gains in your non retirement accounts, offsetting those with some of your losses. So let's talk about what are capital gains, what's a long-term capital gain, what's a short-term capital gain. When you purchase, let's just use Apple stock, for example. If you open up a non retirement account, you want to take money from your bank account and you want to invest it in the markets. You can take those dollars and put them into a non retirement account, also called a non qualified account, also called sometimes a taxable account, which sounds a little bit misleading. But these are dollars that have already been income taxed that you want to invest in the markets. So when you purchase Apple stock, what happens is you're going to establish a cost basis. Your cost basis is the price that you purchased that stock at. So let's say, for example, if you purchased Apple stock at $10 a share, your cost basis is $10 a share. Times that by however many shares you have purchased. That's your cost basis. When you go to sell the stock, the assumption is that the stock has grown in value. So let's say instead of it being worth $10, it's now worth $50. Your potential gain from that appreciation of the stock is going to be $40 a share. That's $50 minus your cost basis of $10. So when you go to sell it, you're going to have to realize a capital gain on that stock. If you've held the stock for a year and one day, that'll be a long-term capital gain. Versus if you've held it for less than a year, that's going to be a short-term capital gain. Short-term capital gains, when you sell the stock, are taxed at ordinary income tax rates, a little less favorable than long-term capital gains rates. Long-term capital gains rates are either 0%, so you might not pay anything in capital gains depending on how much income you've made for the year. You might pay 15% in capital gains, or at the very most, you will pay 20% in capital gains. Most people will receive either 0% or 15% long term capital gains rates. And again, it depends on what your income is. If you are interested in learning more about those, Jordan, if we can put a little graphic on the screen of what the long term capital gains income brackets are, and I can get you what those are. Um, So anything, as I said, anything held for less than a year is going to receive short-term capital gains treatment. If you have losers in your accounts, so if Apple's stock drops to $5 a share, now you've experienced a $5 loss within that account. If you want to potentially take advantage of this tax loss harvesting strategy, you can take the losers in your account, sell those at a loss, to offset capital gains in that are potentially on some of your other funds. So if you had Amazon stock that did appreciate and you wanted to sell that for a gain, you can use that minus the losses, and whatever that net amount is, that is what you will pay for your capital gains. So it can help to offset your gains and potentially lower your tax bill. That's kind of the whole purpose of why we're talking about all of these different strategies. Typically, this strategy happens at the end of the year when investors are evaluating their portfolios. Maybe you're coming into our office and you're doing a year end performance review to say, hey, here's how your accounts have done over the past year. And is there anything that we can do to put you in a better tax situation before the end of the year? Once these positions are sold to take advantage of your tax loss harvesting, when you sell these positions, of course, you're going to exchange them for cash, right? So you're going to get whatever your net proceeds are back into that account in cash. And we don't want to just hold those in cash for the foreseeable future, right? We want to get those back invested in the markets. So, the way we fully take advantage of your tax loss harvesting is, let's say, for example, you had a loss in your Apple stock, but you had a gain in your Tesla stock. Again, as I said, you'll sell your Apple stock for the loss to offset your gain in your Tesla stock. And once your Tesla stock is sold for cash, the proceeds could go, let's say, to purchase Toyota stock, something in the same sector, but it's not an identical position. You don't want to sell your stock for a gain in Tesla and immediately purchase Tesla back because there is what's called the wash sale rules, where you have to wait 30 days, 31 days technically, before you can repurchase the same or a similar stock. So you have to be real careful about this whenever you take advantage of this because you want to make sure you're not going to be hit with that wash sale rule. And it basically doesn't allow you to take advantage of the tax loss harvesting, which was the whole point of doing this whole exercise in the first place. You also can donate highly appreciated stock to charity, where you can literally send your Tesla stock right to the charity of your choosing. And this avoids capital gains altogether while getting some funds out of your estate and being charitably inclined with some of your money that's invested in the market. So instead of donating cash, you theoretically can donate highly appreciated stock. Now, what the charity does with that stock, who knows? But as long as it doesn't hit your income line, that's for them to figure out then. There's also going to be capital gains on your home sale. So if you live in a home and you decide you want to sell it, there's a potential for capital gains because, again, the hope is that your house is worth way more than it was when you purchased it. So if you bought a house for $100,000 and now your house is worth $600,000, that's a $500,000 gain that you might have to realize in the year that you sell it. But there's a bit of a caveat with that. You can exclude up to $250,000 if you're single or $500,000 if you're married filing jointly on the sale of your primary residence. Again, there's going to be some caveats with that. So again, talk to your CPA, talk to your real estate agent whenever you want to take advantage of this. Then going back to estate planning a little bit, there are going to be assets that get a stepped up cost basis when you pass away. The assets that are going to get this stepped up cost basis are going to be things like homes, investment accounts, stocks, bonds, intangible properties, things like that. When you pass away, the assets your beneficiaries inherit can be eligible for a stepped up cost basis. This allows the beneficiary to assume a higher basis than if you had sold it to them while you were alive. If you sell it to them while you're alive, that person, of course, is going to assume a new cost basis of whatever the home was worth on that particular day. So that becomes their cost basis, whatever the market value of the home was whenever the home was purchased. But there's something that's very popular among family members where you may want to sell your home to your son or your daughter for $1 while you're alive so they don't owe you a bunch of money. But what happens in that case is if that's what you sold them the house for, that becomes their cost basis. So their cost basis is going to be $1. Then when you pass away and you want to, your son or your daughter wants to sell your home and they sell it for $500,000, they're going to realize a gain of $499,999 versus if you, let's say, for example, your home was worth $700,000 when you passed away. If you let your son just inherit the house, his cost basis is going to be $700,000. If he then immediately sold the house for $700,000, there's $0 of capital gains versus that $499,999 of gains that they would have to realize if you sold them the house for $1. Now, the caveat is if the son or daughter wants, or any other beneficiary, any other family member, this doesn't just have to be your son or your daughter. If anybody wants to live in the house while you're still alive, there's kind of an exemption for that where they won't have to potentially realize that large gain. But they have to be living there. So if you don't intend, or your beneficiaries don't intend to live in your home, and they're just going to sell it once you pass away, then you want that asset to get the stepped up cost basis for them. Another strategy to take advantage of is investing in municipal bonds or muni bonds. These are issued by state or local governments and are usually exempt from federal taxes and are possibly state and local income tax exempt, but it just depends on the municipality that you used to purchase those. But typically, they're federally tax exempt. You may want to consider adjusting your W 4 tax withholdings. If you get a large tax refund at the end of the year, there's a chance you might be overpaying in taxes throughout the year, that you're having too much of your paycheck withheld for taxes. Adjusting your W 4 can help you potentially keep more money in your paycheck, every single paycheck, as opposed to getting a large refund. Now, again, the trade off is that you may not get as large of a refund, but you're getting more money in your pocket with every single one of your paychecks. Another thing to take advantage of is gifting. The annual gift tax exclusion for 2025 is $19,000 per person. So theoretically, you can give up to $19,000 per person to as many people as you want to in any one given year and not have to file a gift tax return. Now, if you give over $19,000, that doesn't necessarily mean you're going to owe gift taxes, but you at least have to let the IRS know that you made a large gift of over that $19,000. So you at least have to report it. What is going to happen there if you give over $19,000 is that's going to go towards your lifetime exclusion amount. And for 2025, that number is $13,900,000. So that 19,000, the first 19,000 is going to be exempt from, your gift taxes. Then if you give over 19,000, then that's going to start eating away at your 13,000 or your $13 million exemption. Still not necessarily meaning that you're going to owe gift taxes on any of this money, but just something to keep in mind that if you give over the limit, you may have to just file a gift tax return to let the IRS know that you did that. You also can take advantage of what's called super funding of a 529 plan. This is where you are able to put in your $19,000 exclusion amount times 5. So in 2025, that's going to be $95,000 per beneficiary into a 529 plan each year. So this is per 529 account. So if you have 5 beneficiaries, you can do this 5 times for 5 different 529 plans. 529 plans are going to be for education expenses, of course. So you're helping to gift money to your probably grandchildren, getting some of that money out of your estate, and you're also avoiding gift taxes on this as well. Now, the caveat with this is if you do the 5 times the um, annual amount, the caveat is that you can't add more money to that account until 5 years is up. So because you super funded it with 5 years worth of contributions in 1 year, now you can't contribute until that 5-year period kind of resets itself. The other caveat is you also have to outlive that 5-year term for that to be fully exempt from having to, put that money back into your estate and have that money potentially be taxed for estate taxes whenever you pass away. But then once the 5-year term resets, you can do it again. Potentially, if you want to, if you're nearing the top of an income bracket, you could potentially accelerate your charitable donations. So instead of donating, $5,000 each year, perhaps you want to donate 5 years worth of donations in 1 year to lower your taxable income, because again, that's going to be a deduction against your taxable income. So that can also be something else to take advantage of that also may put you over the standard deduction threshold to where you can take advantage of those itemized deductions. There's also certain trusts that can help you avoid estate taxes and give to charity if you're charitably inclined, but that is beyond the scope of this podcast. And so if you're interested in learning more about the types of trusts that you might be able to take advantage of to lower or potentially eliminate estate taxes, certainly talk to an attorney to see what's right for you. And then my last sort of strategy is to purchase life insurance. Life insurance can offer tax free inheritance money to your beneficiaries. So, most of the benefit of this is obviously going to come after you've passed away, but you're potentially putting some more money, giving that and taking it away from your estate to fund a life insurance policy. So that's going to get that money out of your estate and then provide some tax free benefits to your beneficiary. And that's all the time we have for today. If you enjoyed today's episode, give us a like, give us a follow. It's Watch Your Assets on all social media platforms, and we will see you on the next one. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA/SIPC.